This is Andrew Stotz of Stotz Investment Research talking about the valuation model for the company KCE Electronics. First of all, disclaimer, this example was created on the 23rd of January 2017. What follows is not a valuation forecast rating or recommendation, rather it's a teaching example. What follows is not investment advice, rather it's a teaching example. It is intended only as academic information to those who want to learn about valuation. It should not be considered as the basis for any valuation or investment. The information in this presentation came from various sources which we believe are reliable, though we do not guarantee the accuracy, adequacy, or completeness of such information. I hope you enjoy learning about valuations as much as we do. All right, let's get into it. First of all, KCE was founded in 1982. With its 5 subsidiaries, it develops, manufactures, and distributes printed circuit boards and inks for circuit boards, and recycles chemicals used in making printed circuit boards. The company also exports products, with 45% of revenue coming from Europe, 43% from Asia, and 12% from the U.S. KCE is a producer of printed circuit boards which are used in almost every computer device to connect electronic components using conductive tracks. Currently, more than 70% of its revenue come from the automotive sector. KCE operates 3 plants located in Ayutthaya, Bangpur, and Lat Krabang, with total capacity of more than 280,000 square meters. And its sales offices are located in America, Europe, Mexico, Japan, Korea, China, and Singapore. So let's look at the revenue breakdown by business division as of 9 months 2016. Printed circuit boards are 86% of revenue. Prepreg, laminates are 12%, and chemicals are 2%. If we look at the breakdown by region, we can see Europe and Asia are the majority of the sales, and only 12% to America. And it's Americas, so a portion of that is the U.S. So if the new president, Donald Trump, says, I'm not going to import anything, I'm going to put huge taxes on it, this company probably won't be that hardly impacted. Let's go into the forecast section, because any valuation's got to start with forecasting. And what we can see from this forecasting section, let me get my highlighter up here, hold on. And what we can see from that is that the company's revenue growth is right here, and we are expecting strong growth based upon the last 3 quarters or so, and then for that to level out at about 10%. The margin of the company, the growth is very volatile, and we're expecting that it's going to come down over time. Why is that? Well, because margin is massive right now. You can see a 22% margin, which we think over time will start to come down. That's one of the mistakes that analysts often make, is when a company is making a high margin, they forecast a high margin going forward. That's the concept of recency bias, where they're going to carry forward whatever's recent. So I always try to bring it down if it's been really high, or bring it up if it's been really low. Next, let's look at the amount of asset growth. So what we can see is the company made a big investment, and then that asset growth has slowed. So that's good, but eventually they'll have to pick that up because they are growing revenue, and we'll see that that kind of levels off at this point. The main thing, and we want to look at revenue per 100 bought in assets, and we can see that'll improve a little bit over time as they slow their asset growth. The company's dividend payout ratio is about 40, which will increase over time to about 50 during this discrete period. Now, the next thing we look at is the cash flow of the company, and we can see that the investing cash flow is exceeding the operating cash flow. Good news, so they don't have to invest all that, which gives us room to pay a lot of dividend over the next 5 years or so. Operating cash flow as a percent of sales varies, but let's say it's going to be 18 to 20% in the future. Now let's talk about valuation. So when we talk about valuation, the first thing we want to understand is about the NOPAT of the firm, which we can see right here in the forecast for that. And then we look at adding back depreciation, taking away the capex, and then change in working capital here. And then what we end up with is a free cash flow to the firm was massive. We can see right here. And then over time will grow. And then here is our fade period, where we're going to start to fade that free cash flow. Now, the next thing that we do is we look at the return on invested capital, which has been about 20-some%, and that will be, we're forecasting that will be pretty high here, but then coming down. And that is the item that we are fading down over time. So now let's look at the next thing, which is for the dividend discount model. We need to understand about the EPS, and we can see growth in EPS, 26%, 24, 12. Okay, now it gets down to kind of single digits at this point, and that will fade down over time. As far as the dividend growth, well, dividend growth is going to exceed the earnings growth, and that's because the dividend payout ratio will be rising over time according to our estimates. So now let's continue on, and let's now look at the cost of capital and how we get to that calculation. The first thing we want to look at is we know that the country, Thailand's risk-free rate is 4. That's what we're using. And the market premium is 8. Therefore, the market return is 12. Those are our assumptions for the company, or sorry, for the country. And let's just look at this company over the years and say that, well, it's a low-risk company as far as volatility. When I didn't mean to say low risk. What I meant to say was low volatility, because to me, the measure of beta is not really a measure of risk. It's a measure of volatility. What we can see also is that the cost of debt right now is pretty low at 2.8, and we think that that's going to rise over time. And the company is mainly funded by equity, and that's probably going to remain the same. And so the result of that is that the cost of equity here, the 10, is very close to the cost of the weighted average cost of capital. So now let's continue on to the next section, and that is relating to the terminal factors. The company's had some pretty extreme growth, and now what we're going to do is forecast that that's going to come down. And this blue line is the discrete period. And so that means the yellow line's already what's happened. And then we have our fade period where the company is going to be going like that. And so what we have is that the company's final growth, or let's say the terminal growth right now, is 5. That's our highest terminal growth we usually would give to a company. So I would say that if we find that the terminal value is actually quite high in our valuation, we could bring that down to a 3 or a 4. And what we can see is that the final fade period growth is 5. So that's why everything's kind of 5, because it's targeting 5 in that terminal period. So normally this would be coming down from 10 to 9 to 8 to 7 to 6 to 5. And so the next thing that we want to do is understand the multiples. Now, these multiples are how we get our terminal value. And the multiple is 1 divided by K minus G. And that shows a pretty high multiple because we have a very high growth rate. Remember that the terminal growth rate could never be higher than the growth rate of the overall economy, or else the company over time would become bigger than the economy, and that's impossible. So now let's go through it, and already what I can see is that, well, this 11%, 10% of the value is in the next 5 years. We can see that a lot of the value is in the terminal period. We've seen some pretty high terminal growth that we've forecasted in that. So if we were going to adjust that, I would say that would be something we could consider adjusting. And again, this is a teaching example, so we try to understand the levers there. So it's possible that that terminal value, if that came down, the value here would come down a bit. But overall, what we can see is that from a DDM basis, the DDM usually underestimates relative to the price. So, but if we look at a free cash flow basis, we can see that the valuation is about in line with the current price. Is it expensive? No. Is it cheap? No. So now let's look at the valuation relative to the infotech sector. So this is relative valuation. And what we can see is that the PE of the company is about 20 times. And the company has EPS growth that's pretty significant. That 20 times is bigger, is higher than the market, so it's a little bit more expensive. But also, the growth is higher than the market. So the PE to growth ratio is about 1 right now, and lower is cheaper. So it's basically cheaper than the alternatives in Thailand. And it's a little bit more expensive than the alternatives in Asia. If we look at the other side, less volatile is the price to book to ROE ratio. And we can see that price to book's a little bit high relative to Thailand, almost double the amount. But the ROE is almost double the amount also. So if we looked at those together, what we can see is that, well, right now it's a little bit expensive relative to Thailand and Asia ex Japan. So again, I wouldn't say that this looks like an overvalued stock, but it looks like it's a little bit expensive from a multiple perspective. Now let's take a look at the sensitivity. Remember that we look at 4 factors: sales growth, margin change, discount rate, and terminal growth rate. And what we're doing is looking at base case and then plus or minus. And here, let's just take a look at gross margin, and we can see gross margin tends to be the most impactful for most companies. So if we go from a 35 plus 5, that's a 40% gross margin, then EPS growth would go from 15 to 21. And if that went down to a 30% margin, that would go down to 7.6. If we look at it from a free cash flow perspective, that small change in that EPS growth is 1 year, but that will carry on for many years going forward. And so that will add value to the company's value here, and it will detract from value here, right? So that gives us an idea of KCE, and I hope that you can learn from that. And if you have any questions or comments or experience with it, leave them up there because I want to talk to you. Have a great day.